Over the course of the early 2000s, housing prices were rapidly climbing. Access to mortgage lending, along with other programs, were driving millions of Americans to buy a home. And the demand for mortgage-backed securities on Wall Street was ensuring that the credit was not going to end. Where in the past, most mortgage lenders would keep the loan for its entire duration, now almost every mortgage any mortgage lender originated was bundled up with others within 3 months and sold off to investors. Mortgage lenders faced essentially zero risk because they were selling the mortgages off to these bundlers, and the bundlers were willing to accept mortgages issued to subprime borrowers, or borrowers who had low credit scores. Once again, we need to have some humility in our assumptions about people. Lenders were willing to give mortgages to people with a history of not being able to repay their loans. That sounds stupidly risky, but remember, the key innovation of the financial industry over the previous decades was tools for pooling risk so that it became predictable. These innovations were opening up possibilities that were not previously available. It was now possible to give people who made mistakes when they were young a second chance, offering them the same opportunity at home ownership as those who had more support. But the rising home prices did lead to some very risky behavior on the part of borrowers and lenders. One example of the sort of subprime lending that was problematic were mortgages with balloon payments. These borrowers would be given a mortgage with no money down. When you don't have any money to put down on a house, it's almost impossible to get a good interest rate. These subprime mortgages would offer them a nice low interest rate for the first 2 years, but after 2 years went by, they had to pay the rest of the mortgage off all at once. People would borrow hundreds of thousands of dollars for a home, make 24 payments of a couple thousand, and then all of a sudden owe hundreds of thousands for the rest of the mortgage. They did this with open eyes, though. Their plan was to refinance the home 2 years later. When you refinance your home, you're essentially taking out a new mortgage under better terms and paying off your old mortgage with the money. When housing prices are going up, refinancing can be a great deal. You can buy a house for $240,000, say, but 2 years later, the house is worth $300,000. Because the house appreciated in value by $60,000, and in a mortgage the house is put down as collateral, it's like being able to make a $60,000 down payment on the home. Having started with no money down, the borrower is essentially putting 20% down due to the appreciated home price, and that gives them access to a normal 30-year fixed rate mortgage at a low interest rate. It's a really great arrangement for the borrower, but only if the value of the house goes up enough over those 2 years. In the early 2000s, seeing the value of your home rise considerably in 2 years was the norm. It was a hot market. I remember being in my youth at the time, and at night these long infomercials would come on television with people trying to peddle a get-rich-quick scheme that involved buying houses and selling them months later at a huge profit. But then, after decades of housing prices always going up, the bubble burst, and they suddenly started to come down. The people who bought houses with adjustable rate mortgages or mortgages with those balloon payments were suddenly left with a bill they had no hope in the world of paying. Refinancing their home was no longer an option because the value of the house had fallen below what they owed, and no one was willing to lend more money than the house was worth. Mortgage delinquency went from under 4% to over 11% over the course of 2007 and 2008. And the fuse was lit for a bomb that would shake the entire financial industry. Investors and credit rating agencies had thought that the historical pattern of mortgage delinquencies would hold forever, but instead those past relationships were broken. The sudden rise in delinquencies due to the drop in housing prices meant that the bottom tranches of the mortgage-backed securities all went under and stopped paying out. The money feeding into the collateralized debt obligations dried up, and entire securities went bust. A forest fire of delinquency was causing everything to go bad all at once. The key here are these investments, the top tranches of the CDOs that were supposed to be totally safe. And the investors who put their money there did so because they didn't want to take on any risk. When they started to go bad, those risk-averse investors saw their portfolios drop substantially, and not wanting to lose any more money, they called their brokers at the investment banks and they pulled their money out. Bear Stearns was the first major Wall Street firm to be hit by a run. They were the 7th largest investment bank in the world, but their customers were panicking and closing their accounts. With money pouring out, Bear was at risk of bankruptcy. The Federal Reserve, which was headed by Ben Bernanke, stepped in with a $30 billion loan, despite the fact that Bear Stearns was not a normal bank. Bernanke came from academia and had spent his career studying the Great Depression. Perhaps more than anyone else on the planet, he knew the importance of keeping the financial markets calm and not letting a run spread from one investment bank to the next. He put the leaders at Bear Stearns together with J.P. Morgan and provided the guarantees needed to get Morgan to buy Bear Stearns and keep it from collapsing. Things calmed, but over the summer of 2008, the subprime mortgage crisis kept growing. By September, another financial giant was seeing its reserves depleted by panicking customers and falling asset prices. Lehman Brothers had gone big on CDOs, and they were losing incredible amounts of money on them. It was clear they would go under if no one stepped in to stop it. But fear of a public backlash against bailing out another big bank meant the Fed and the Treasury weren't willing to help out with government money. Instead, Treasury Secretary Hank Paulson and the president of the Federal Reserve Bank of New York, Tim Geithner, brought the heads of every major financial firm together to try to put together a plan to save Lehman that would come from the private sector. Essentially, they needed one of the large banks to buy Lehman Brothers and guarantee its deposits, but doing so meant taking on these toxic assets whose value could not even be determined. Paulson and Geithner eventually convinced the British bank Barclays to agree to purchase Lehman, but British regulators nixed the deal. On Monday, September 15, 2008, after 158 years in business, Lehman Brothers filed for bankruptcy with nearly $700 billion in assets. It remains the largest bankruptcy ever. Lehman Brothers had over 100,000 creditors it would no longer be paying back, and nobody really knew the full impact it would have on the market. At first, markets held steady, and some praised the decision to let Lehman fail as good governance. Lehman had made huge mistakes, and it went bankrupt because of those bad choices, not because of something out of their control. But soon after, analysts started to realize just how bad the situation was. The insurance giant AIG had sold massive amounts of those credit default swaps, and the massive increase in defaults was threatening their entire business. AIG provided insurance to millions of people and businesses. If they collapsed, it would set off a chain reaction of bankruptcy that didn't just threaten the financial industry, it threatened the entire economy. The 2011 film Too Big to Fail dramatizes the attempt to save Lehman Brothers, and William Hurt plays Treasury Secretary Hank Paulson. In this scene, he can't sleep, and he explains to his wife how dire the situation really is.
There's not a bank in the world that has enough money in its vault to pay its depositors. It's all built on trust. And Wendy, we are so very close. Morgan Stanley and Goldman are an inch away if the other banks stop trusting them, if they pull back on Interbank lending, it's over in a matter of hours. And from there, it goes. Too fast to stop. A run, and not just one bank, I mean, on the whole system. Average people wondering, is my money safe? They start pulling their cash. And after that, lines outside the bank smashed ATMs. A couple of weeks. There's no milk in the store.